Global headline this morning is the fact that the Chinese PMI data has once again come in contraction territory and is at the 6.5-year low. The CAIXIN PMI has come in at 47. Sanjeev Sanyal, the global strategist at Deutsche Bank, joins us now to talk more about that. Sanjeev, hi, good morning. Once again, weak data coming in from China. Do you think things have gotten from bad to worse, and what is the expectation here on?
I think you need to be very careful how we interpret this data. There is no doubt that China's economy is slowing, but I think extrapolating that into saying that China is having emerging market crisis type situation is perhaps also not right. China's growth is slowing. It will slow past below 7% this year, but this is not a cyclical downturn. This is a structural shift away from China's investment-driven growth model, and this will happen over several years. I mean, the country has enormous external and internal resources to smoothen this. So really, this is a structural shift, and I think we need to interpret it in that context.
Yeah, that point is taken, Sanjeev. Good morning. But what we would like to know is, therefore, will the manufacturing numbers continue to contract? Ultimately, that has a bearing on China's trading partners, on the amount of cheap steel and tires it sends abroad, and on commodity prices in general. So should we see this PMI tick going from 47 to even lower for the time being?
Well, PMI is it's not an indices, so in that sense, the tick may or may not go down. Even if it remains at this level, it suggests slowdown. So that's not the right way to think about it. But more broadly, yes, with every year you will see China growing a little bit slower than it did in the previous year, and yes, it does mean that you will see somewhat weaker demand out of China for various commodities than had been maybe extrapolated in the past. As I keep pointing out, this is part of China's transition from being the world's factory to becoming the world's investor, which means that as it slows down, it will also simultaneously keep pushing out huge amounts of capital to the rest of the world, which, as I've been making this point for quite some time now, will keep the cost of capital globally cheap for a long time to come.
At the moment, we are less worried about the capital. We are worried about the cheap steel that they are pushing out. We just had the Jindal Stainless guy 2 minutes before you came on air, Sanjeev, who was, deeply worried about the amount of Chinese steel dumping that he is forced to face on Indian shores. Is there any respite to that, or that continues?
I think China's own demand for many of these commodities, including steel, will be soft for some time, and even if it picks up, I think given the amount of capacities, there will be a significant amount of overcapacity for some foreseeable future. So ultimately, as far as the world is concerned, I think what you will need to see this excess capital that I talked about being absorbed somewhere else in the world in order to generate growth and demand and investment that will suck up this excess steel. And frankly, in the end, it will have to be the US.
Okay, so so far we've seen a lot of stimulus coming from the Chinese government itself, but do you expect some more to flow through, and do you think that could alleviate some of the stress that it's facing in terms of slow growth?
I think what you're seeing in China is a smoothing out of a structural slowdown. So this is not the case that these easing measures on the monetary side, for example, are going to cause a return to the old days of growth. At most, you will see it smoothing down this downward trajectory. As I keep pointing out, this is not going to be a hard landing, but at the same time, this is not going to be a cyclical upturn either. And instead, a significant proportion of this stimulus that you are talking about will leak abroad in some form and become capital outflow.
Okay. The Chinese government indicated, the Premier indicated that they are going to expand the fiscal stimulus from 7% to 10% at the World Economic Forum. will this make a difference and we will start to see China consuming other things? I mean, we have seen a steep fall even in their car consumption. One can see it in the Tata Motors numbers. Should we start to see Chinese consumption improve and alleviate many people who are selling consumer goods to China?
Well, you may see some smoothening out, even some recovery. But let's be very clear, what is going on is a long-term structural shift in a country where the workforce is already shrinking. By the end of this decade, the population will be shrinking, and it is a very high savings country where the savings rate may decline as a result of higher consumption. But the fact of the matter is, this savings rate is not going to fall fast enough to keep up with declines in the investment rate, and therefore you will have this slackness in demand for a long time.
Do you have a view on what's happening in the other part of the world, that is with the European economy, Sanjeev? Because yesterday and today, or rather in the past 2 days, we've seen quite a bit of a sell-off in European equities. There's this whole Volkswagen problem which is ballooning as well. But is it only one or two company-specific issues, or do you think over there too there could be some slowdown worries?
Obviously, these are specific company issues which I can't comment about, but the fact is the European economies aren't really gathering a lot of momentum. Many of the exports out of, say, Germany, or capital goods exports, will also have been affected by the slowdown in China. So the real issue for us is who in the world is going to absorb this excess capital, and frankly, we would be grateful if the Europeans don't add to the problem by trying to export their way out of this. So I think the best we can expect out of Europe is that they don't add to the problem and at least absorb their own savings to keep the system going.
Okay.
They certainly are not in a position to absorb China's excess.
Okay. Sanjeev, today we got some comments from Ruchir Sharma. His point is that Asia is now in a trade recession with everybody's exports falling. And total quantum of trade falling. Global manufacturing growth, he says, incremental growth has come to a standstill. And he calls this signs of global economy being close to a recession. Would you agree with that?
Well, I wouldn't like to comment on somebody else's views. I would say that it is the case that the world economy is not gathering pace. That includes the industrial economy. Unless some large economy somewhere in the world begins to take this excess capital and begins to put it into some good use, presumably into large-scale investment, you will be, even 1 year from now, remaining in this limbo land where there's large amounts of capital sloshing around, occasionally causing bubbles, but really the economy not getting going. Now, this is the context in which you have to realize that the US economy is critical. I mean, India may or may not gather steam, but it's too small. The US is the only other really genuinely large economy that can take this excess capital, deploy it. There are lots of good things you can do in the US. Anybody who's been to the US will know that US infrastructure is appalling. There are many positive things you can invest into in the US. But it requires a political will to get on with it. So I think really it is again coming down to the old problem of requiring the US to provide the demand of last resort.
Fair point. Sanjeev Sanyal, thank you very much for joining us. The key takeaway immediately for investors as well as for traders is that the global recession, if you please, or recession-like conditions are not going anywhere, are not getting mitigated anytime soon. As Sanyal says, that even 1 year down the line, we may still be grappling with the same problem of overall global growth not picking up.